Hey everyone, welcome back to the channel. If you are looking for ways to generate extra income from your stock holding, especially in this bearish market, particularly in the US, right? This video is for you. Today, I'm going to dive into covered calls, one of the simplest way to effectively earn some extra income whilst still holding the shares of that particular security. In this case, I'm going to use the example of Walmart, which I currently hold in the interest of full disclosure. But as I always say, this channel, I create content for educational and entertainment purposes, even though I'm going to be using a classic example of a stock that I'm holding. Now, the most important thing is to simplify things, at least for me. So, what is a covered call? All right. So, simply put, a covered call is an option strategy where you sell a call option on a stock that you already own, which means that you get paid a premium upfront in exchange of agreeing to sell your shares at a specific price known as the strike price. If the stock reaches that price before the option expires. Now, what do I mean by this? Now, why is this called covered call strategy? Well, because you already own the stock, right? In this case, I own the 100 shares of Walmart. So I'm covered, right? In case the option gets exercised, and that's different from a naked call where you would have unlimited risk if you didn't own those shares. So let me just show you so that you see here a real example so that you have an idea of what I'm talking. So here you can see that I recorded this. I think this was on Friday, on the 21st of March. And just to be sure, this is for sure 21 March. I own these 100 shares of Walmart, and you can see my average here is 80, it's $85.98, let's say 97 cents. And right now, Walmart, let's say I write a covered call, like in this case, I actually wrote a covered call and I have one contract and I got paid 72 cents. So one option contract is 100 units. So 100 times 0.72, I get paid $72. So I will get paid $72 in this case if I hold this until the 28th. And let's say Walmart now stock is now at $88. So that means I will make the $72 that has already been debited, I've already received, plus the difference between my average and the strike price. So in this case, let's say it's $102. So that would be, let's say, 175 US dollars. Now, you see, the advantage in this case is I already got the money upfront, right? 72 cents. Now, if it doesn't reach this, let's say Walmart is at $85, yeah, let's say $86.99. That means I'll get to keep the premium of $72 in my shares. Then I'll write another covered call, right? Let's say now I get another $100 for a weekly covered call. So that means at the end of the month, if I repeat this same strategy, what that means is if I'm making, let's say, for simplicity, $100, and my shares are not called away, and I put it at least outside of the money, right? The strike price, that means I will still make, let's say, $400 whilst still holding the shares. And I only do this for stocks that I already want to know. What is Walmart? Most people here in Canada and the US, they know that Walmart, grocery, if you want to do groceries and clothes, it's a big shop, right? Retail shop. And you see that in terms of when I did my analysis, they have very good, a very strong balance sheet. They have good management. They also have fantastic, and growing free cash flow. So I did analysis on the stock and I'm fine holding it because in this, let's say if we have a recession in the US, people who still want to buy food and clothes, even though clothes might be not as much as if the economy is booming. So for me, that's another way that I do. So now think of it, if I have, let's say, Apple as an example in full disclosure, but that's for my different account. Let's say I have Amazon, I have Google shares, and my average is good, right? And I could then say, if I'm getting, let's say I have, let's say 200 or 100 shares, let's say if of each, and let's say I have 500 shares and I'm getting a premium of, let's say 1,500 every week. What that means is I will actually make 6,000 from this, right? So I can just do that. So what some people do, they do what is called a wheel strategy. You start by selling cash secured put. In other words, you open the position. Let's say I want to buy shares for Apple. Let's say in this case for Walmart, the same example. But right now, let's say it's at $86 and I want to buy it at 83. So what I would do is I will start by, let's say, I have the cash in the brokerage account, but then I will sell a covered call, a put in that case, and then I get paid a premium. And then if Apple, let's say the strike price, if Apple, Walmart in this case, drops to that level, I get assigned the shares. Let's say it drops to 83. And then that means I should have the 8,300. Then I buy the shares, right? But I already have been paid a premium, let's say $100, right? So if now I now have the 100 shares, I can then now start to use the covered calls. I would write covered calls. Let's say now it's trading at $85. It goes back to $85. So I already have the $2 in profit, but I want to keep the shares and hold, let's say, for 5, 10 years, right? So if it continues to grow, I can now continue to write covered calls. Now I do the same thing that I've been doing. So I'm collecting premium, more like dividends, or collecting rent for an asset that I have, in this case, which are the shares. So that's the wheel strategy. And a lot of people, that's what they do. But the key thing is that I only like to hold stocks that I like, that I understand, and that I want to hold for the long term. I'm not going to be writing covered calls or even holding those stocks that I don't want to hold or to own for the long term. So I understand that in the US right now, the S&P 500 is in the correction territory. It has dropped by at least 10%. So what that means is, and there's a lot of volatility. I used to day trade a lot, right? So but now it's very risky to do that. So what I am now doing is I've shifted my strategy. I have few stocks that I understand that have really, dropped to my, what I believe to be undervalued, because of maybe tariffs and all these reasons. And what I'm doing is I'm collecting premium for that. So if I write weekly covered calls, right? Let's say, like I said, I get, let's say, just as an example, I get 2,000 US, and these are US stocks, so I get this premium in US dollars. So if I make, let's say, 1,000 every week, and my shares are not called away, I will still make 4,000, and it reduces the average cost for my stock, right? And over the long term, if it then appreciates, I just write the covered call for a strike price that is higher. But everything, there are also risks that are attached. Let's say now if I have a covered call and the stock drops, but remember I opened the position by selling a call option. So what that means is I'm covered, because if it drops that option, I will still be able to recoup. Let's say it drops from 85, my average, and it drops, I will still be able to make money, because as it drops, it's more like it's a hedge, right? But I may not get the full 8,500, but I'll get at least a significant amount. So that's a downside. Now, if let's say Walmart, I have a strike price, like for example, $87, it goes to $90, I would forego that potential profit above my strike price, right? But that's, in that case, my profit target is kept at that level. But at the end of the day, for me, I am just happy because I'm getting this premium. I'm holding stocks that I want. And at the end of the day, I will repeat this and make money. So that's the advantage. I love generating extra income, cash flows from stocks that I already own, but it's also, in my view, it has lower risk, unlike other option strategies that are naked, that are not backed by a position. Now, it works if the market goes sideways, bullish, bearish, right? As long as the strike price is above, right? So as long as it moves and it doesn't go up. If it doesn't, if it goes up, assuming my average price is lower than the strike price, I'm still profitable. I wrote another covered call in the other account for Apple. I got in at, let's say, $211. It's already at 218 when I close, when it closed, right? $218, 30 something, right? It's already $600, but I got, let's say, $121. So let's say by Friday, which is the expiry for my contract, option contract, it goes to, let's say, 122, and then my strike price is 220. Now I have already made, let's say, $700 in that, plus the 121. So that's a $700 trade for a week. But of course, you need to have 21,000 US dollars for you to be able to buy the 100 shares, because you can only write options, at least to my knowledge, if you have 100 shares for that underlying security. So that's it for covered calls. I find them to be a very good strategy to generate some income. But the most important thing is, for me, my experience, I am doing covered calls only for stocks that I want to own, that I have done research on, that I understand, and generating free cash flows. At the end of the day, that's my goal. I want to be generating some money. Some people get dividends, but now I am using this and sometimes trading. So thank you so much for tuning in, and I hope you found this to be helpful. And I will consider doing other videos for other option strategies that I'm using to generate income, to at least go in detail. And I'm a practical person. I'm telling you things that I'm doing, but I'm not saying follow what I'm saying, right? Without doing your own research or your own due diligence, because it comes with risks. And I've done some research and I could be wrong, but the most important thing is I'm comfortable with what I'm doing, right? So don't forget to subscribe and like this video so that it goes viral. See you in the next video, and bye-bye for now. Thank you for tuning in.